All right, so Trudeau resigning. He's going to stick around until there's a new leader. Parliament's going to be prorogued. What's the overall impact do you expect on energy?
Today is a fantastic day for energy investors. It's one that I've been praying for many, many years. Very clearly, Justin Trudeau's economic policies over the past 9-10 years have been a total failure. But specifically for energy, as Canada is the third largest holder of oil reserves in the world, fourth largest producer, it would be impossible to have asked for a more antagonistic prime minister. It started off with comments about having to phase out the oil sands, and then went into the cancellation of Northern Gateway, the passage of Bill C-69, which has made it impossible for another pipeline to be ever built in this country again until it gets canceled, of course. The passage of Bill C-59, the anti-greenwashing bill, which threatened oil companies with multi-billion-dollar fines if they dared say things such as, phasing out Chinese coal with Canadian LNG is a bad thing. And then on natural gas, we had a prime minister that displayed such profound energy ignorance by saying that there was no business case for LNG, despite global leaders flying to our country begging for it. And so the interest level in Canadian energy stocks has been high, yet the accumulation of all of those antagonistic policies has prevented foreign capital from being invested in Canada and being invested in Canadian energy stocks. And so today's announcement, I think, is the beginning of the elimination of the political risk discount being applied to our stocks.
So you believe that Prime Minister Poilievre would be good for energy and energy stocks. Could you give us a few reasons why?
Absolutely. So the biggest one has been the lack of funds flow into Canadian energy stocks because of the fear of some of the policies that could have been or were announced, such as the emissions cap, which is dead on arrival, of course, at some point this year, but it was an effective production cap. Carbon taxes on our producers, where we produce one of the most ethical and now clean barrels in the world, and yet we were in fact, we are the only oil-producing nation on the planet to put carbon taxes on our producers, making them uncompetitive relative to foreign producers. And so it's really the elimination of proposed legislation, the elimination of the potential for any wacko policies further to be announced, and just making our companies more competitive. Because when you look at our businesses, we have companies now with the meaningful slowdown in U.S. shale growth. And in fact, I think we're now at the twilight of U.S. shale, where companies in the United States have the inability to grow further. The investor, the global energy investor, is going to be looking around the world, and their focus should be on Canada. We're blessed with an abundance of reserves. We have companies with very, very strong balance sheets owing to years of deleveraging. We have companies that are committed to low to no growth, maximizing free cash flow and using that to buy back their shares year after year after year. And so our stocks should be trading at a premium to their global peers. We trade at a discount to their global peers. And the only reason for that has been a government over the past 9 years that has been incredibly antagonistic towards this space. And so this, I think, was the beginning of a multi-month catalyst to allow foreign investors to once again look at Canada, to realize a lot of the competitive advantages that we actually now have, and to allow for the elimination of that political risk discount, which could be very, very meaningful.
So as that discount is dissipated, are there a couple of names that really stand out that can benefit?
Well, I think the biggest beneficiaries are the Canadian oil sands. Without getting name specific, we saw a very significant sell-off in the second half of last year, especially in December. I had a front row seat to seeing how vicious tax loss selling was. And so any oil stock that was negative going into December just got absolutely pounded. We've seen a modest recovery from the lows. We think there's still a catch-up trade in several oil sand names that are going to be returning more than 10% this year. That's at $70 oil. We're now trading close to 75. And so for some names, especially some in the mid-cap space, which remain out of favor, we have names that we think are going to be returning 15 to 20% this year at, let's call it, an oil price close to where we trade. We also have the benefit of natural gas, where we finally have winter arriving. We have 2 LNG facilities in the U.S., one now, LNG Canada, coming online, and the ongoing increase in demand from data centers and ongoing power demand. In the United States, it was up last year for the first time in 16 years, owing to the demand for power. And so not just the outlook for oil, we think fair value is roughly 80 to 85 versus 75 spot, but the outlook for natural gas is very, very strong. And so when you look at Canada, we now have obviously TMX, which has reduced the discount to Canadian oil. LNG Canada in the coming months should reduce the discount on Canadian gas. We have a weak currency where our producers are getting a 40% uplift on their revenue owing to the weak loonie, and the prospect of improving prices both for natural gas and oil. And so, we remain bullish in the outlook for Canadian energy producers. We think the ongoing impact of meaningful share buybacks financed out of record free cash flow at a time when energy stocks remain very, very mispriced. You can go out today and buy companies trading at 3 to 3.5 times cash flow, 15 to 20% free cash flow yields that have been especially pounded over the past month due to the worst tax law selling that I've seen in easily a decade. And so we remain really, really bullish and optimistic on the outlook for energy stocks in 2025. We think it's going to be another good year. We were up roughly 13, 14% last year. We remain very optimistic for 2025.
Just lastly, Eric, still with natural gas, we know that there is a cold snap in various parts of the United States, snowstorms, the price has been doing well. But you also mentioned the need for natural gas for data centers, or at least the use. And apparently that's up about 10% year over year. Is that a meaningful pillar to underpin the price of natural gas?
It's a long-term secular growth story. We think we're in a multi-year bull market for natural gas now. Often people said that natural gas is a bridge fuel. It's going to bridge us to a time when we have solar and wind. That's complete, absolute nonsense. There is no energy transition. There's no energy transition when the demand for oil, natural gas, and even coal continues to make all-time highs. And when you look at the necessity for 24/7 uninterruptible power, very clearly wind and solar do not work. And so we think it's a multi-decade investment theme for natural gas. And Alberta especially has massive competitive advantages for this, where it's next to some of the largest reserves in the world, which now trade at a meaningful global discount. And secondly, it's cold. And so the necessity to keep these centers cold or cooler rather than other jurisdictions is a huge cost advantage. And I think you're seeing increased investment interest there, so it's the combination of data centers, more meaningfully LNG. The United States is almost doubling their LNG demand between now and the end of 2030.
Right.
Canada, we're starting from zero.